the Bank of Canada just made a huge announcement. And guys, I am here today to tell you the truth, because while it is exciting to hear that rate cuts are, first of all, happening and still coming later this year, I think there's a lot more to the story that is being under-discussed. So for those of you that have been on Instagram at any point in the last 24 to 48 hours, depending on when this video specifically gets uploaded, you've probably seen every realtor in your life flooding your feeds and your stories with kitschy little posts about how the Bank of Canada just cut rates, and they're celebrating and popping champagne and writing things in the comments about how this is only positive whether you're a buyer or a seller or a market participant in general, and it's just a cause to celebrate. And honestly, I wanted to stop for a second and say, I don't know that this is something we need to blindly celebrate, and the rate cut is not actually the entire story of what's going on here. So this announcement is exciting, and while it is probably true that there are actually a lot of benefits to both buyers and sellers in some way, conceivably, as a result of today's announcement, I do think there are broader economic implications of what did get announced today, and that's why I'm here to break down exactly what that means for all of you. So let's get started. What did the Bank of Canada actually announce today? The Bank of Canada announced their sixth consecutive rate cut, this time a quarter of a percentage point, or sometimes called 25 basis points. That brings the Bank of Canada lending rate down to 3%. For comparison, the United States Federal Reserve interest rate is between 4 and 4.25, meaning Canada's is now a full percentage point lower than the US's. More importantly, what is not getting discussed by the realtor community or very often on social media at all is the Bank of Canada's early end to their balance sheet normalization process, which I will elaborate on in just a minute. They also, as a part of their end of balance sheet normalization, announced the resumption of asset purchases or quantitative easing as early as March of this year, which is a dramatic shift in policy to the Bank of Canada that we saw for the last 2 to 3 years here. And I do think this will have real consequences for Canada as a nation, and particularly as it pertains to our economy and our currency. So I'm just going to break down a couple of definitions in case some of you aren't aware of what some of those larger words mean, namely quantitative easing. Quantitative easing is when a central bank buys government bonds or other assets to inject money into the economy. It lowers the borrowing costs, but it is known to devalue the currency. And some people, especially Austrian economists, say to switch the words quantitative easing with money printing in your mind whenever you hear them. It's a little bit of an oversimplification, but you get the idea. Quantitative tightening, on the other hand, is the opposite of quantitative easing, and that is when the central bank sells off assets or lets them mature and pulls money out of circulation, with the idea being they want to cool inflation down. The process of balance sheet normalization is essentially the central bank making a concerted plan to normalize the amount of debt they're holding after a period of quantitative easing. The Bank of Canada was in the middle of this, but they decided to abandon it slightly early here due to economic risks, namely tariffs from the United States. So in simple terms, what actually got announced here? It means that the Bank of Canada is going to start printing money again in March. This is a lot bigger of a deal than a quarter point rate cut, I hope you realize. So, as you guys know, I'm a realtor, not an economist, and not anything more fancy than a licensed realtor in the province of Manitoba. So I can talk to you first about how this will impact real estate, especially in Winnipeg. But for the other implications, just consider me some guy on YouTube who probably lives in a basement. So, lower rates generally mean higher real estate prices, and that's something that has been the case for many, many decades now. In any period where rates have gone significant fluctuations, pricing has generally tended to follow. We've seen this before in the pandemic era, where we had a very uncharacteristic run-up from about mid-2020 all the way till approximately May of 2022. And as rates normalized, the market seemed to have hit a local bottom and began rebounding very significantly. For those of you that read my monthly market updates or follow me on Substack, you'll be intimately familiar with this because it's been something I've been writing about now for almost 3 years. So, what happens when rates go down? Buyers get higher pre-approvals and holders of real estate get lower mortgage costs. This means a few things. First of all, rental property becomes much more attractive. Even if your rent no longer covers all your bills, it's going to at least be closer. This is something going on in some of Canada's more metro locales, such as Toronto, where people are regularly holding cash flow negative rentals. In a city like Winnipeg, it just means there's more opportunity for a home buyer to offer more money on a house. So what does this do for sellers? It increases buyer demand, and it increases the liquidity that they will have selling into a market at virtually any price. Now, if you want to know about the specific dynamics of Winnipeg, I have other videos about that, and I have a whole Substack about exactly how the Winnipeg market behaves. I'm not going to get into that here. However, this policy shift that we saw from the Bank of Canada today is exactly why I made my $472,000 benchmark price prediction for Winnipeg for spring of this year. I anticipated that the rate cuts were going to happen. It didn't take a genius to do that, by the way. The Bank of Canada literally said they were going to. However, they did also say that the quantitative easing part would happen later. And this is where I say there's a catch, because it is a little bit more complicated than that. So, the concerning side of this announcement is the Bank of Canada has subtly hinted, or actually in some interviews thereafter, they actually openly admitted that they made this decision with potential US tariffs in mind. And they expect actually that these tariffs are very likely to push Canada into at least a mild recession. And they are trying to get ahead of that. Obviously, that's not necessarily their mandate. They are supposed to control employment and inflation, but realistically speaking, most of what they're doing is managing recessions when they're talking about quantitative tightening and easing. So, our interest rate spread with the US is still holding at about 1%, meaning the Canadian dollar, which is already deeply down against the USD, namely 7% in the last 12 months, and actually nearly 20% since spring of 2021, is now poised to possibly go lower. So in the event a recession were to hit, the Bank of Canada would probably have to cut rates even further or print even more money, and that would likely result in the Canadian dollar taking an even more massive hit than it already has, which comes with its own set of problems. Namely, imports get a lot more expensive. This is stuff like food, fuel, and everyday goods, groceries. Anything that you buy that isn't produced in Canada is going to go up in price. This is inflationary, and it's going to leave the central bank between a rock and a hard place, where they're going to have inflationary pressures due to their very weak dollar, and they're not going to be able to cut rates because that's going to inflate the currency even more. Additionally, travel outside of Canada is going to become more expensive. Your Canadian dollar will buy less abroad, notably in the United States. So if anybody was thinking of going to Florida this winter, you might want to do that sooner rather than later. The more concerning one of all of this, in my opinion, is that foreign investment may start to leave Canada because a weak currency discourages outsiders from coming in and investing in the country. Canada is in a unique situation where our 5 largest companies on our Toronto Stock Exchange currently are all the banks, and realistically they are essentially a 5-company monopoly. The outside investment outlook in our country is already poor. And with a weak currency and a very bizarre monopolized economy, I think it's very unlikely we're going to be attracting new investors anytime soon. So, with all of this in mind, given the announcement, it's likely enough that Winnipeg real estate prices will probably go up. We all can agree on that. Most people are saying that. However, if the Canadian dollar keeps falling, those gains could realistically be meaningless when you adjust them for purchasing power. So, where does this leave us? Well, as far as Winnipeg real estate goes, I stand by my prediction of $472,000 being the benchmark high this spring 2025. However, I worry that those increases in price won't actually translate into real wealth increases if our currency continues to get weaker, particularly against the US dollar. I've been saying it for months, but I do not think the Winnipeg real estate market requires this stimulus. These actions are being taken with the broader Canadian economy in mind because, to be honest with you, our housing inventory, especially for mid-market desirable homes, already is sitting low, and we have buyer demand that is stronger than I've seen pretty much since the very peak of the 2021-2022 bubble market that we just lived through. So, these rate cuts and this end of quantitative tightening and resumption of quantitative easing is very likely to help our short-term real estate values, but I do think this is also setting us up to create some very, very unfortunate long-term economic stability, particularly as it relates to the value of our currency. So I want to know, what do you guys think about all this? How many more times do you think the Bank of Canada is going to cut rates this year? Will they let the CAD fail against the US dollar, especially in the face of tariffs? If we do have a recession, how bad do you think it's going to be? If you found this breakdown useful, I want you to hit that like button and remember to subscribe for more real estate market insights, particularly as they relate to Winnipeg and the Canadian market. So if you're out there, stay smart, stay informed, do your own research before making any financial decisions. And remember, I'm just a basement dwelling realtor. I don't know what the hell I'm talking about, and you definitely should not listen to me. See you in the next one.